On today's episode of the AI Investor Podcast from 24/7 Wall Street, we're sharing the details of the latest stock Eric is about to add to the $500,000 AI portfolio we announced last episode. We'll answer a few listener questions and fill you in on the biggest AI news from the past few weeks. All that is next. Welcome back, everyone. I am David Hanson, and I am joined by my co-host and 24/7 Wall Street colleague, Eric Bleeker. Eric, we have a lot to get to again. We had a long show 2 weeks ago, and frankly, one of my pet peeves is when podcast hosts just get on here and chit chat for 10 minutes about the weather and how are you doing, how are the kids. I love your family. I want to hear, but maybe not today. So if you don't mind, I'd like to just kind of jump straight into the content, into the questions that we want to start off with from our listeners. Is that cool with you?
Let's get to it. Yeah.
All right, so we got a question, and this question was from Steve. He said, really enjoying the new podcast. I was curious about Intel. We brought Intel up a couple times last week about it being in the doghouse a little bit. And Steve says, they've been dominant for all my life. Why are they suddenly struggling so much? And is there a price that they are a buy? So Eric, again, I mentioned we brought up Intel last episode. Why don't we dive a little bit more into just what's the story behind this company right now?
Yeah, it's a really good question. We were... specifically, I was a little harsh on Intel last episode, and I think the bottom line is I would love to see Intel succeed. America needs a dominant chip manufacturer that's based out of America. It's too strategically important. So I think there is going to be a defense of Intel, right? If it is at this point analogous to the too big to fail banks, right? Now, the problem with Intel is they essentially have an unwieldy structure. They want to both manufacture chips for company and design their own chips. So they're essentially asking companies that they would be a competitor to take their technologies and have Intel manufacture them. That's been a much harder sales pitch than they ever imagined. And they haven't been able to take kind of the tough medicine of splitting up those businesses fully. And now they are to the point that they no longer have the capital structure that they used to have that would have allowed them to, fully make this transition. So in the past couple of weeks, they've announced some restructurings. There's also been some news, other companies smell blood in the water. ARM Holdings, it came out just today. They had made an offer to Intel to essentially take over their design business. Qualcomm has essentially been circling them. I don't think you're going to see Intel selling off that asset anytime soon. It sounds like they have rebuffed those offers. But you're also going to see some companies. I think a lot of the big tech companies, they're very savvy. They realize, too, that there is a little bit of a political angle here. And Amazon recently gave Intel business. I think that's as much about Intel's capabilities as Amazon getting ahead of keeping some production, with an American manufacturer. Now, the question, is there a price that we would move in and purchase Intel? Not at this time for me. I think there's a good chance, actually, Intel will see some near-term gains. It is setting up a position. It's got some momentum behind it. But the key takeaway from this is mostly manufacturing chips is exceedingly hard. Even if these companies are mostly using technologies from equipment suppliers like ASML, Tokyo Electron, there's still tremendous amounts of knowledge and know-how to be able to economically make chips. And it's most of all a testament to Taiwan Semiconductor, how well they've done this, at the margins they've done this. And it's not just Intel that's struggling. There are some questions whether or not Samsung can keep up in the market of the most advanced chips. So I think we've made our play in this market with Taiwan Semiconductor. If we're to continue adding, I would probably just increase my position in that company rather than look to Intel, because again, I still think their corporate structure is too unwieldy, where they haven't taken the really hard medicine of detaching their design and their manufacturing business. And until they do that, I don't think they can effectively compete at the level we would need to see to own that stock.
And you threw out the words too big to fail. And I think last week you said maybe there's going to be a government intervention or government bailout. So when you talk about a bailout, are you saying that this company is going to fail and they'll need capital to survive? Or is it more, the government's just going to be in their business trying to kind of keep it afloat, and that's just something you don't want to have to deal with? Where, like, define what you mean by like government kind of intervention and bailout for this company.
I think it could take many forms. I think it could be direct investments that provide capital. I also think that there could be incentives for U.S. companies to effectively use them. That would be the most attractive if you're an equity investor, but it is still unclear. It's just Intel, they're trying to make a lot of transitions right now to kind of catch up and some would say even surpass Taiwan Semiconductor. The problem is when you're moving that fast, you might be to more advanced technology, but you didn't have the learnings along the way to make it really economical. So what they're doing, I think, is a little riskier than most investors fully realize. And if that risk brings about the idea that, yes, moving along these, you'd call them process nodes to the most advanced technologies, it is extremely capital intensive. And Intel, they spent a lot of their capital, taking on debt, paying dividends. They've ceased that now, but they've kind of reduced their margin of safety. And rather than have a company like that be bought out by a foreign company or, have capital problems, I think you would see the government look for some creative solutions because there's no alternative to not have a company in this race for the United States of America. It's too important to national security.
Well, the stock is down now 50% year to date. So, whatever kind of pessimism that you're bringing across here, certainly the market seems to kind of agree with you. You mentioned there's some momentum, there's some support for it, but obviously the market is not giving tons of signs. Again, especially we talked about some of the gains we've seen in the sector this year, and for the stock to be down 50%, it certainly speaks volumes of the market's opinion.
Yep.
So let's move on to another question that we got from Josh. It says, there's been a lot of big name sellers getting out of NVIDIA recently, yet you added it to your portfolio. How much does this worry you? We had David Tepper, owner of my beloved Carolina Panthers on CNBC. Maybe investing is a little bit more his forte. We'll see. He was saying that, they've been in, they've been out, a little worried about the future of NVIDIA. I've got a quick, audio clip we'll play from Tepper here, and then we'll come right back to your thoughts.
Those stocks like NVIDIA is a question. Do you have enough power, for the growth? Do you have the next generation models that can take their chip? So it looks great in 24. It looks great in 25. I have no idea in 26 and 27. I am no idea. Okay. I mean, if I was good, I don't believe my analysts. I don't believe any analysts. I don't trust myself.
All right, Eric. So we heard Tepper there. What is your take? Are you scared off when you hear someone like David Tepper, express some skepticism about NVIDIA, even though you just added it to the portfolio?
Yeah, David Tepper, owner of the Carolina Panthers, or the Intel of NFL franchises.
Too soon.
I think his point's very valid. The concerns are for a lot of investors. It's not just him; it's also Stanley Druckenmiller, some other major investors who have made this call, that we see a lot of positive momentum into 2025, but we have a little bit more limited visibility in 2026 and beyond. The fundamental idea behind the artificial intelligence market is that there's a scaling law where the more compute we have, the more data we have with the current technology in AI models, the more we apply of both of those, the better results we're getting. And the idea is there's not going to be a substantial decline in investment as long as this relationship holds. So anyone who tells you that they know what's going to happen in 2026 and beyond is lying to you, because no one has a definitive answer. Now, as we'll discuss later in the show, there's news in the past 2 weeks of potentially kind of a fundamental breakthrough that can continue to move AI models forward that could change the trajectory of what NVIDIA demand looks like in 2026. So my main thesis that I've been working with NVIDIA is I do think 2025 demand, and specifically for their Blackwell platform, is still underestimated from Wall Street. I really like what the next 12 months looks like. but we will have to kind of evaluate how we hold the position based upon new information that we're gathering along the way. And that's part of why we wanted a portfolio, because I don't think, even though NVIDIA is a core position, I don't think it's necessarily buy and hold forever. I am willing to take that position down or accelerate depending on market changes. So for now, we've put at 5%. That's actually pretty small relative to its placement in AI. It's more likely we'll take it up. But I think in the knowable areas that we look at, I still haven't seen any substantial degradation of NVIDIA's competitive position. I think a lot of the moves that they made to enhance their competitive moat, especially in the networking arena, were brilliant and kind of underfollowed. And I think they will continue to reap the rewards of this. And as we stated, it's along a continuum of 20 to 35 times forward earnings. Depending on where it is in that, zone, will largely dictate how much we're adding to it in the portfolio. And right now it's kind of in the middle, right? So we've taken that initial 5% position, but depending on what we see news-wise, we will be willing to change that in the year ahead.
Cool. All right. So I think those were our two questions that we wanted to hit. I want to jump into some news. As always, between doing the show 2 weeks in between, there's a lot of news that comes out in this space. And it honestly feels like every 2 weeks, there's some new big theme that seems to be grabbing headlines. And it really seems like the last 2 weeks has been kind of the energy implications of AI. And they're, here talking about nuclear and old plants coming online. And how are we going to deal with all this compute? So the first headline that I wanted to talk about was the Microsoft deal, reopening 3 Mile Island. It's a 20-year deal to operate this plant. Do you see this as a model that we're going to continue to see, or just break down a little bit? Why is Microsoft doing this? And what does that mean kind of going forward for other companies in the space? Yeah,
I think it was like The Onion had put Microsoft goes for 3 Mile Island because Apple's trying to beat them to Chernobyl, right? It's kind of a funny headline that they're going for 3 Mile Island, given the history. But what a nuclear plant offers is it's going to be 800 megawatts of energy, which is equivalent to the power for, I think it's 800,000 homes.
Jeez.
So, it's an astounding number. We saw some reports earlier this year of Microsoft working with OpenAI and what was being dubbed internally Project Stargate. And it was a push to be able to make a data center that would effectively cost $100 billion. It would require dedicated nuclear power, and it was targeting somewhere in the time frame of 2028 to 2030. So it's interesting because you see these fantastic ideas that you wonder if we can actually get there. And now you're starting to see these plans in a way put into place. I think there is something very real here beyond Microsoft and this 3 Mile Island announcement. In the past couple of weeks, there's also an announcement from them that they're building a $100 billion partnership, and I believe that's with BlackRock and a couple other companies, to be able to make AI power investments. And there's another news story this week that OpenAI, which, it's partnered with Microsoft, they went to the Biden administration asking to approve 5 gigawatt, which is equivalent to 6 3 Mile Island nuclear plants, just to power these, massive data centers that they're looking to create. So I think if there's a takeaway from this, it is just, we talked about that Larry Ellison quote last week. The people in this space are extremely serious about $100 billion plans that a largest data center today, you're looking at something closer to 1 billion, and we're going up to 100 billion. They are very serious about this 100x growth. And we are moving from the conceptual phase to actual actions. So if you're looking at AI, we've said a lot, this isn't necessarily a straight path up. There's probably going to be some zones, some air pockets where, the gains in stocks aren't as apparent, but the companies are planning for the growth levels that reach kind of the bull case for this market. And I just think you have to look at this and appreciate the seriousness of the companies involved.
Yeah, I mean, just to throw out $100 billion, it's such a mind-blowing number. But then you also remember, you bring up Microsoft. when it's a $3 trillion market cap, it's almost like, I could speak for me, your brain almost has to reset to this new level of how large these companies are from both a market cap perspective, but then also revenue and profits and cash on their balance sheets. So it's truly just like a game of titans when you have Microsoft, Amazon, Apple. These companies are so massive. When 100 billion it's obviously a lot, but these companies are massive in a way that we just have never seen before.
Well, and that was Larry Ellison's quote last week. He said the stakes to play are going to be 100 billion, and he was doing that over a series of years. He's not pulling that out of his rear end, right? He's hearing that from other customers and their plans and competitors. So again, it's who knows what happens to the funding environment, or whether or not, these companies start facing stock pressure and want to pull back on their capital expenditures. But it sure does seem like they have a 5-year plan that is exceedingly ambitious.
Yeah, and you notice the market seems to be a little bit more excited just even over the last couple of months about these very, very large companies. You look at kind of the forward PE ratio of Mag 7 type. The Mag 7, I think it's drifted back up into the 30 times range. And I think it was maybe in the low 20s about 2 years ago. So the enthusiasm has certainly increased in terms of the growth expected from Wall Street is starting to get baked in a little bit more.
No
So that's
question.
where, to your point of, it may not be a straight line up. If there are some air pockets and growth slows, that's where you could see those multiples, really change. But if their growth is there, then, maybe it's fairly valued at a 30 times PE for a $2-3 trillion company, but remains to be seen. So you mentioned OpenAI and asking for 5 gigawatt massive energy, and Sam Altman's there's been a lot of quotes of him going around saying, this is the future, this is everything. I need he needed $7 trillion going around asking for that. So.
He went to Taiwan Semiconductor, I think, said, I need 7 trillion worth of, I think he went like 36 fabrication facilities. And it was an audacious enough claim. They started just calling him podcast bro around their offices. So from
2 podcast bros to him, we can, he's certainly a character that I think there's criticism of him making these very bold claims that every white collar job will be eliminated in 6 years. I'm not saying he said that exact thing, but he has these very bold claims that some people can be critical of being a little bit too over the top and too promissory of this future of AI. But then, OpenAI has been a successful company, both in terms of adoption of their consumer product. I think it's hundreds of millions of monthly users that are still using ChatGPT. And I think they're raising capital at over $100 billion valuation. So they've been successful. But then I also saw this week that there's, more headlines of executive departures from this company. So, I observe the company, but as someone who probably just spends a little bit more time in the space, what the heck is going on with this company? You think it's this rocket ship, but then why does there seem to be so much turmoil? There was a board issue last year. Now there's executives leaving. What are we supposed to make of the situation at OpenAI?
Yeah, it's going to make a great movie someday. That's for sure. It's going to blow the social network away, right? I think your point there is really good, highlighting Sam Altman and his background. The kinds of claims he's making, you always need to listen to what he's saying with a BS detector, because he has every incentive in the world to really play up numbers, right? Because he's out there fundraising. If I've seen critiques from OpenAI employees that he's not in the office day to day or involved, because he is essentially constantly on the road, on a roadshow, kind of promoting AI, right? And that's part of your job as a CEO, but all the same, he definitely does take it to a very high level. Now, let's just unpackage a little bit. There was a very important story about OpenAI's actual products this week, and as you mentioned, they are over $4 billion in annual run rate. So they have some momentum, but they released a new model, which is had been codenamed Strawberry, and it's 401 is the name of it. And it's kind of a fundamental change to how these models, these LLMs work, which a big problem that LLMs have is they hallucinate. They give weird responses, and it makes them very hard to trust. And that's just a factor of their what you call imitation learning. And there's an alternative way of working, of creating these models called reinforcement learning. But the problem is you're essentially reinforcing these models for having the right answer, but it requires human involvement, and it has a hard time scaling. So their breakthrough with the Strawberry model is essentially they're using something called real-time inference, where they are using inferencing for the model to effectively, what you'd call it, think and reason. And the more time the model spends inferencing or thinking, the better answer you get. So I talked about earlier, we need to be really adaptive to changes of what's going on. I had been, and just, I want to pause here because it's even, I need to take it to a fundamental level to say, with models, there's two areas for, all this AI revenue coming in for a company like NVIDIA. There's training, which are actually creating the models itself. And then you have inferencing, where you're kind of running the models, right? And I've been a little more bullish on the training side, because there has been some data out that I believe Goldman Sachs said there's such an inferencing glut coming that there's going to be no possible way to basically use all the inferencing capacity that we're creating. So that was true maybe up until 2 weeks ago, when all of a sudden you might have something where the demand for inferencing might suddenly, the total addressable market, as you would call it, might be up 100-fold. So whatever priors you had just had a nuclear bomb dropped on them potentially, if this is the way that AI models are going to be built going forward, right? And how we want to separate this podcast, David, right? We don't want to just tell the news. We want to tell people how you are actionable on the news, right? So when I'm looking at Strawberry and trying to understand it and trying to fit into how we invest, all of a sudden, different companies get a lot more interesting. I think AMD will have some gains in this. They've been a little bit stronger in inferencing, but I think the one that, is going to move up a little bit in terms of our conviction list is Broadcom, because all of the big hyperscalers, the Microsofts, the Googles of the world, this is going to, if this becomes the standard way of operating AI models, it's going to mean that they want more inferencing capacity, and they're probably going to want to build that with their custom accelerators. And the company that designs it for them is Broadcom, by and large. So I think there is a very specific, number one, if this is a fundamental better model, it's good for AI. It's good for every AI company. Second, there's probably going to be some outsized gains to Broadcom. So that's just an example of, we're watching the news and something very material happens, and we're going to have an outcome from it. It might change how we were thinking about things 2 weeks ago. Now, second, what's happening at OpenAI? I know it took me forever to get there, but what's happening is essentially it was started as a nonprofit. It's scaled in the past year from 700 of the most talented and smart, like research-focused people to 1,700. And their model, I think the recent report is that they are changing out of a nonprofit structure entirely. There's contrasting reports whether or not Altman is taking a $10 billion stake in the company. I don't know. He says he's not. The media says he is. I think it's largely growing pains based upon that it's a company that started out with very research focused, and now it's becoming kind of a product focused company with 4 billion plus in revenue. And you are seeing the growing pains there. So I think OpenAI is they're not giving up their leadership at all. They're still going to be amongst the biggest leaders, but it is definitely presenting an opening for other companies like Anthropic and also Meta or Facebook to kind of catch up with them.
In terms of, it sounds like it's a kind of a complicated situation moving from a nonprofit to a for-profit company that's scaling to the size. Do you have any sense of, or what would be your best prediction of, when would we see an OpenAI as a public company? Is this going to be an example where it's going to be another like 8 years where the private market is just so deep that they can continue funding, they have to deal with Microsoft? Or is this like, hey, in 2 years we might have a public OpenAI? Or do you just have what would be your best guess of when we get a view because it is such an important company that we don't have a view into its numbers and the economics of everything. Do you have an opinion on that?
Man, that's a great title for this podcast. It's a complicated situation. Everything about OpenAI is just so weird. Another weird thing about them, like you have this Microsoft investment, they're kind of partners with Microsoft.
Right.
But if they reach artificial general intelligence, which is kind of the endpoint that is causing all this investment, I think that that ownership is effectively dissolved. So how you even model that into, values is just, I don't think we'll see them come in onto the market in the next 2 years. Part of that too is just I think I saw a stat yesterday. There's 2 IPOs last year and 1 this year. So if the window's open and they're valued at 500 billion potentially, but so much of AI is going for this long game of reaching this AGI. And there are so many, true believers there. I think a lot of their funding would like to see them try and reach this exit point rather than being content with only a $500 billion gain, right? They are truly looking at the, massive scenario.
Right. Okay. Well, I'm sure we'll discuss OpenAI on future episodes, especially Sam Altman. I think he will be a staple in our news coverage here. So I want to move on to Micron, a company that was up big after earnings. This is a company that's had a pretty wild year from a stock price perspective. I think at one point it was up 80% year to date, and then it had a 45% drawdown. So pretty volatile, which I also just wanted to remind listeners, like, that is such and this is $100 billion company, like investing in these companies, when you talk about air pockets and like, if you're going to be scared out of a stock, because if you're going to sell when it's up 80% or down, we're going to see these moves in these companies. I think that's a given. So just prepare yourself that's not going to be maybe an unusual experience for a company. So I want to talk a little bit about Micron. Why was it down so much? Why was there so much negativity? And what did you see in the earnings that gave you kind of excitement about what might be going on there?
Yeah, memory, it's a wild ride. AI or not, and AI is just probably putting, some jet fuel behind this wild ride. So basically what happened with Micron is in the memory space, you've got, you can see the spot prices for how much memory costs, and it's volatile on a continued basis. And so a lot of the Wall Street banks were seeing that the spot prices for what you'd call DDR4 memory was decreasing, which that's the majority of, revenue on Micron. And they loaded up into it. Estimates came down. They load up short on this. There was a lot of money betting against Micron. Now, what's happening is as you're undergoing these rapid transitions, the data that used to have very good signal for what was going to happen is losing that. And part of the decrease in this DDR4 is that there's a shift ongoing to the next generation, DDR5, which wasn't fully captured. And Micron was able to project a very above consensus Q1, I believe, 8.7 billion revenue versus estimates of something like 8.23. Also, margins increasing, which is really important in this space because you're constantly kind of watching how big these competitive pressures are. Now, why I want to talk about this a little bit more is bubbling beneath the surface. A lot of people might not think of memory as a top AI play, but there's a specific type of memory that's being used across, all the different accelerators and GPUs, and it's called high bandwidth memory. And essentially what it is instead of putting memory around the GPU itself, it stacks on top in layers. So it's essentially taking memory 3D, and it creates a lot higher bandwidth, and it's a lot more energy efficient. So the market for high bandwidth memory, according to Micron, 4 billion last year, next year going up to 24 billion. So I think there is, a belief amongst a lot of people, the markets where there's a lot of growth in AI, you miss the best of it, but you see for HBM, there's still a lot of growth ahead. And specifically Micron said that they are last quarter, I think it was like 100 million in revenue from HBM. And next year, I think their number was several billion. So you can see the growth rates. And there's a few different very positive earnings this week across the technology space. Another company, Tokyo Electron, which I think we will be adding to the portfolio ahead. That's a company that they said they're looking at 150% AI related growth next year, and it's going to move up to 30% of their business. So, David, we're always watching. NVIDIA got so many gains because it wasn't replacing anything. It was all upside. Some of these other companies, Micron, it's HBM's growing, but that might be swamped by weakness in other products. Tokyo Electron AI is growing 150%, but they might be seeing some weakness in legacy technologies. The bigger AI gets as a piece of the pie, the more that growth is reflected in their top line. So I think any investors looking for weakness in AI, we've actually seen quite the opposite in recent earnings releases.
So when you talk about the legacy businesses of Micron, is that just PCs, smartphones that may not be growing quite as fast? And then give me a sense of where does Micron fit in? Who are their customers? Is it when you're building out a data center, you're buying GPUs? Who is the one, contracting with Micron to buy the memory? And give me a sense of where it fits in this ever growing, ever complicated stack of coherent and data centers. And so where are they in this kind of economic process in the stack there?
Well, I mean, you're going to have if you're a company like, let's just say a Super Micro, maybe not the right company to talk with right now, given what's going on with them, but they're selling a server, they're going to have the logic, which is your NVIDIA chips, and you're also going to have the memory alongside. As I said, that memory is now packaged on top. So, your end customers, if HBM at this point is supply constrained, that's a huge problem for NVIDIA because you need memory at that bandwidth for your chips to work. So recently, Micron's been a little bit of a smaller player in this market. There's two competitors. One's Samsung, another is SK Hynix. SK Hynix has actually been the most attractively valued, and they have the highest exposure to high bandwidth memory. The problem is they're a Korean stock. If you've got like an Interactive Brokers account, you might be able to buy them, but generally most people aren't able to. So Micron's been kind of the easiest option for investors to get in and play this market.
Okay. Sorry. So that was Micron. Maybe one on the watch list for the not adding to the portfolio now, but certainly watching this kind of that segment of their business.
Yeah, I definitely think so. Again, it's a relatively cheap stock in a cyclical industry, but one that may be still underestimated by Wall Street.
Okay. The other piece of news that I wanted to hit on, maybe not, I don't think we need to spend too much time, but we had a big Meta event this week. Zuckerberg was out there in some sort of new outfit that he's wearing now, looking cool, I guess. So they announced some new glasses that seem to be kind of the biggest part of their presentation. So where do you stand on the Meta glasses? Obviously, the metaverse has been quite a story for Meta over the last couple of years. They went all in on it. I think Zuckerberg has even kind of admitted like, we were kind of off a little bit. We're a little slow on the AI thing, and now they've pivoted. So what is your thoughts on these glasses? Is this something to pay attention about? Is this important to the Meta story at all? Or is it just kind of like it was a fun company event that we're going to share some new stuff?
Yeah, I think if anything, it's really showing the kinds of wounds that Meta as a company went through in late 2022. They went down to, I think it was $80 a share. They're back up to low under 600 right now. And it was because of this outsized investment in Meta, in the metaverse, and people not believing in kind of the outcomes. Now, today we know that investment, they spent a ton on GPUs, allowed them to get ahead in AI. It actually was a good investment for maybe reasons not expected. But they kind of, these glasses aren't supposed to be commercialized for like 3 to 5 years, I believe is the time frame. But they have to get out. They have to show what's coming because they need to allay kind of investor fears in this market. I think it's an interesting demo. I don't think it's an iPhone moment, but it does really reinforce that for something like glasses, you're going to need to pair that with AI, because if you want voice to be a primary interaction factor, you need predictive measures to be able to make it very useful, because people on their own don't know, how to almost be constantly prompting that system to make it useful. So I think it's just one consumer market where we're seeing that AI is going to fundamentally rewrite most consumer products in the next 5 years. And in this case, this is Meta's attempt to do an end around Apple, right? But I think Meta overall, it's a pretty attractive company even at these prices, and it's attractive even valuing these AR efforts at nothing. And the potential catalyst is if they ever unwound it, they just become fantastically more profitable. So I wouldn't see this as a catalyst for buying Meta, but I think in a way they are a buy in spite of this.
Yeah, it is interesting when you listen to a lot of the interviews that Zuckerberg gives recently, and just a lot of the media attention is on the AI efforts, whether it's Meta AI or building, Llama, their open source model. Now you have the glasses here. When ultimately it's like their business is still advertising, and they are using AI to improve their advertising delivery and improve the yield. So all of it's kind of a distraction. It is important to continue to focus on that core business, which that's really what also got them out of that slump. The advertising business really started growing again after the changes from Apple. So, if you're a Meta shareholder, I think all this stuff's interesting to follow, but ultimately it's like, how's the advertising business doing? And I think that's, they are one of the few companies that is using AI, as we've talked about in previous shows, to actually improve their core business, and they can get real yield out of their core business.
Yeah. And in numbers, I believe they're going to increase revenue something like 25 billion this year, and the incremental addition of AI on that 16 billion. So what is that? 60%. When you break it down, that is very impressive.
Okay, one more news story, and then I know we're going to get to the new stock that you're going to be adding to the portfolio. I wanted to talk a little bit about Salesforce announcing agents. This is something that we hit on last episode, where you're talking about a big trend that we might see in 2025. We're not to 2025 yet, but now we have this pretty large influential company kind of coming out early and saying agents are going to be kind of one of their big forays into the AI market. So what were your takeaways on the Salesforce announcement?
Yeah, I don't think we need to discuss this too long. They had done their big conference. They also brought a comedian who just spent the entire time roasting them, which got most of the attention. It kind of buried this agent storyline. But yeah, we had talked about agents. It's going to make the most sense being in customer service first. So it makes all the sense in the world that Salesforce wants to get out in front of it. And I think the idea that they are putting this as, a key product offering for next year, it's still they kind of released it and they've got a lot more work to go, which is to be expected. But our, point in the last podcast was we're going to see a lot more attention. It's going to become a key theme of 2025. And I believe this was 4 days after our podcast, and we saw the first major announcement. So, if you're watching for catalysts and you had that on your bingo card, we can start checking it off.
Cool. All right. Let's move on to probably what most people want to hear about, and that is the portfolio. So let's quickly review the 4 companies in case we have new listeners that we added to the portfolio. We don't need to go super in depth. I encourage anyone to go back and listen to the prior episode if you want to hear kind of the full thesis. But let's quickly review the 4 companies we added last episode, and then let's talk about the new one that you're going to be adding next.
Yeah. So last week, we had started. I'm investing $500,000 of my own money in Plainsight. We're going to discuss the investments every single week, and it gives kind of a, core centerpiece to this podcast, that we're not just kind of discussing the news. We are talking about how to invest, and we're putting our money where our mouth is, and we're putting something that, people can objectively follow. So the first 4 stocks that we discussed were NVIDIA, which is NVDA, Coherent, COHR, Synopsys, SNPS, and Taiwan Semiconductor, and that is ticker symbol TSM. So again, you can go back and you can get some of the allocations to them. One thing we're doing as well, we will announce the trades on our social media profiles if you go and follow us. We wanted to give everyone a chance to buy these stocks before us. And if you did go and buy Coherent, I believe we're getting about 20% worse price than when we announced it. Specifically to Coherent, stocks have done generally pretty well in the past couple of weeks because we got 50 basis point cut from the Federal Reserve. I had mentioned discussing Coherent. They carry a pretty reasonable debt load, which in a declining rate environment probably means that they're going to see some gains. We saw it play out pretty quickly, right, with a 20% gain. So, an early congrats to anyone that might have bought Coherent on the day or the days following that announcement. But as you mentioned earlier, we're not looking for victory laps for short term because there's going to be weeks where we don't deserve victory laps, right? This is a long-term play that we believe will benefit over the long term. So maybe, David, do we want to move on to, the new stock today, or do you want to discuss the portfolio?
Let's go to the new one.
Okay, so one of the key themes that I had discussed last week in terms of where we're going to likely see growth in AI in 2025, I've been talking about the networking situation. Specifically, an analogy, I was talking with someone yesterday about data centers and the need for a lot more spending in the networking side. And they said, it's kind of like with F1 racing, you might have a great engine, but if you don't have a suspension and all the other pieces, you're not going to have the best car at the track. And what we're looking at is, if we think of the GPU from NVIDIA as the engine, that's been the primary area where we've seen tons of investment. But we're going to need to see all of the surrounding areas in the data center see a lot more investment if we want to get to these data centers that we've been talking about today that are currently being planned for, that are costing up to $100 billion. And one of the key areas is networking, because right now these GPUs and data centers, they might have low utilizations. They're not being used the majority of the time. One of the best ways to get improving utilization is to spend more money on advanced networking technology. Now, a lot of these stocks too, there's a little bit of built-in negativity towards them because traditionally there hasn't been a new reason to really invest in this market, right? You're not seeing the kinds of ROI you're going to see with a massive GPU data center. So we're trying to invest in front of the inflection point of really high spend in this market and get leaders. So the stock I wanted to talk about today, that's Credo, and it's CRDO. Now, David, I'm not going to, excite anyone too much when I say that their primary market is active electronic cabling.
Finally, I've been looking for a play in that market.
And I doubt I'll excite other people saying that they have other growing businesses such as optical digital signal processors. But here's the key point. We need to move to faster port speeds that are able to have a higher, throughput on data. Right now, most of their sales are in 100G, 200G. What we need for these huge AI data centers where you have 100,000 or more connected GPUs, we need to start moving to 800G and beyond. It's always an out there promise where you don't know exactly where this revenue is going to hit an inflection point. But the belief is that Credo is going to start seeing some big acceleration in the back half of 2025. And what we could effectively see is a more than doubling of their AI revenue in that period. As we mentioned, it starts off small, and as it becomes a larger portion of business growing at that rates, it begins swelling growth rates. So again, this is a company, you don't need to be an expert in active electronic cabling. Lord knows I am not. You just need to know the overriding opportunity. And that's what we're going for. We're going to start making bets about basically this AI networking play. And this is just the first. I'm going to start this since this is a small company. This is $5 billion. It's the smallest that we've added to the portfolio so far. I'm going to start it at 1% allocation, which is starting at $5,000. And in the weeks to come, I'm going to continue looking, I should say, for more plays to add in this space, because I think ideally we're going to be at somewhere along 5 to 10 companies, all at 1 to 2% allocations. and we're going to spread out our bets on companies that have gonna basically hit an inflection point in revenue as we make this transition to 800G port speeds and above. So that's the new stock for today. It becomes the fifth stock in the portfolio. But like I said, we're going to continue, exploring this trend, and it's going to be kind of the basis to get us above 10 stocks in the weeks to come.
You mentioned your plan to kind of look for more plays in this space. Not to reveal all your secret moves, secret sauce. Give us a taste of what's that process? How are you going to go about? We may have listeners that want to go do it themselves. Where are you starting to look? Is this through it doesn't sound like you're doing a stock screen of, hey, I'm looking for this type of company. So what is the way that you are going about finding these types of companies? Because I'm willing to bet that maybe one or two people have heard of this company, maybe zero of our listeners. So where do you stumble upon a Credo, and where are you going to keep looking?
Yeah, with Credo, so I'm looking places like teardowns of NVIDIA's Blackwell servers, and I want to see what companies are seeing the most benefits from them. It's interesting because Credo, actually, they would like NVIDIA as a customer. It would be a huge catalyst. I don't believe NVIDIA is a current customer of them. I'm also looking at things like what hyperscalers, what companies are saying that they're engaged with hyperscalers, which once again is just the biggest cloud companies like Microsoft, Google, who's saying that they have design wins with those companies that they're believing will scale, because my bet is it is going to scale on time, and it's going to scale at a larger rate than you'd expect. A company that I've been buying call options on my personal portfolio, when valuation dependent, is named Applied Optoelectronics, and that's AAOI. I believe I've talked about them. I've definitely written about them on 24/7 Wall Street, and they have a relationship with Microsoft, and I don't necessarily know what competitive advantage they have in any kind of really in-depth perspective, but I appreciate their industry and their, relationships that they have. So that's a company I probably would have been comfortable adding them, but they're up like 100% a month. So I'm going to continue looking through other alternatives and options. So, it really is, I find companies, I go through their 10Ks, I look for competitors, I look for related companies, I read research from different publications I subscribe to, and I try and arrive at a group. And I also, we have to have the humbleness that it's not necessarily in a theme like this that we're going to pick out the dominant winner. It's that we're betting on the overall idea, and we're going to try and be as effective as possible spreading our bets. So it's really, sweetener to our overall returns in the AI space.
Sounds great. And again, like you said, that's the purpose of this portfolio, to try to give listeners some real life guidance, some real life perspective on how big is this company. And I think some people might be like, oh, it's only a 1% position. I think that's very informative about how we're going to start building the portfolio. When you talk about finding more companies in this space, I think that's really actionable. Eric, I think that's all we have for today. Again, if you want to follow the portfolio in terms of more in-depth, kind of just, maybe you missed an episode of the podcast, you want to make sure you see it, follow Eric on Twitter. He's at Bleeker Tech. You can also follow 24/7 Wall Street on Twitter or X, whatever you want to call it these days. When we announce these new editions, we'll post all the details there, some thesis, so you can follow along. So again, we also take questions. We did them at the top. You can email questions at 247wallstreet.com. We'll answer your questions. And lastly, again, please leave a review. Just hit the little like button or the 5 stars on it takes 2 seconds. You just pull up your phone, hit the little review. I know everyone asks, but we really appreciate more reviews, more feedback. Again, also feel free to email us feedback on things you want to hear. So Eric, that's all I got. Anything else before we sign off?
Yeah, just a shout out to some of the listeners who have reached out. Got a great email from Jesse today. If you're out there listening to this, I appreciate you writing in to say that you left a review and you're enjoying the podcast. And again, we have the email address. It's questions at 247 Wall Street. That's wallst.com. we want to answer your questions. We took a couple at the start of this episode. I've still got some bank questions I'm going to do in later episodes, but we want this to be dynamic. We want this to be a community. So if you have any questions about the stocks referenced today, if you have questions about AI, technology, to the extent we can answer them, we want to talk with you. We want this to be kind of collaborative. So make sure, write in. We'll do our best to answer whatever we get.
Sounds great. See everyone in 2 weeks.
People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.